Hello, everyone. I think that we're ready to start. So welcome to the last webinar of our webinar series. This one is going to be about revenue-based financing. As you may have noticed, it's not Jaime who's going to teach the webinar. It's going to be me. So maybe I can start by introducing the agenda of the webinar, and then I can go a bit super fast about who I am, and then we get deep into revenue-based financing. Okay. So the agenda for today is we're gonna start with a brief introduction, both about myself, the company, and what we do. Then we are gonna get into the different financing alternatives we can find out there. The first 15 minutes are gonna be focused on traditional financing alternatives, meaning banks, public fundings, or venture debt. Okay, we're not gonna cover venture capital because it's completely different. And then the next 30 minutes, we're gonna go through revenue-based financing. This is, I would say, a new concept that started some years ago that is really focused on startups because they really understand their needs and they are willing to assume a higher risk because they try to understand better the dynamics. Okay, and they of course get higher returns because they're assuming higher risks. Okay, and the last 10 minutes we can go through questions, stories, examples, or yeah, just to discuss a bit together. Okay. So who I am before we get into the company. I'm Juvenal. I'm a CFO Director at the Startup CFO. I have previous experience in different companies. I graduated from business and law. Then I've worked mainly in investment banking and in huge banks or in small funds advisory company. I've worked in France, Portugal, and Spain. And I joined the Startup CFO almost 3 years ago. So in these 3 years, we have launched different business lines. The main one that we have is the external CFO services for startups, now with 2 different countries where we serve, that are Spain and Germany. We currently serve actively in CFO around 50 startups. We have worked with more than 200 in our 5 years of experience in 20 different countries, well, more than 20 different countries. I personally have worked with startups in Africa and in the US, lots of countries here in Europe. And in the company, we're currently more than 25 as of now, with what I mentioned previously, our recently launched new office in Berlin, where we already have a country manager. In fact, today, part of our team is attending an event there in Berlin to try to expand our brand in Germany. Okay. All the webinar series are available in YouTube, and you can find also a lot of content related to startups and finances for startups specifically. Okay. And I think that we can get into financing. Okay. So the first thing I want to cover is the reason why this webinar is important. You may all have seen that recently in the last year and a half, maybe, the market dynamics for startups have changed a lot. So we come from years 21, for example, 2021, despite all we had in 2020 with COVID, was an amazing year in terms of growth, investment, valuations. So the feeling was that VCs had to pitch to startups so that they accepted their investment. Now we are back to the opposite. So we now see that it's really hard to raise funds. the market conditions are complicated, valuations are really low. So there was a big downturn early 2022, I would say. It started to fail. And we saw these consequences in investments, difficulties from startups to get new funds, or even to get funds at good conditions. Okay, so there is well, here you can see some news about this turnout, and there was a great shock last year with an important announcement that Y Combinator did. So they sent out a message to all the startups in their portfolio, that is this one, where what they warned to their startups was difficult times are coming, prepare for the worst, adjust your cost structure to the current situation where you're maybe not going to raise funds as you expected. Try to extend your runway somehow. So before, there was this public mindset of a run has to last 12 months. Okay. When this happened, their message was try to aim to 24 months runway. Okay, because we don't know what is gonna happen, and it's better to have the cash in the bank and to readjust costs, and at least until we know or we have more visibility over what can happen in the future. Okay, so this is just the message that for us it was a huge message when we received it at the company, because we had to start working with all of our startups in what to do, okay, and to plan the next months and try to see how we could extend the runway, mainly or both by cutting costs or by trying to get different ways of funding. Okay, so what have we seen now? That what was announced has happened. Okay, so the big impact of Silicon Valley Bank bankruptcy was huge. That was the trigger where we saw like, okay, now everyone is panicking. Like what we anticipated, or what Y Combinator anticipated and we assumed are as a real warning has materialized, and now the economy is facing a downturn, not just in terms of startups, but globally, because of geopolitical situations or because of whatever reason, but it is real. What we are seeing in 2023 is that many startups are just applying to, like, trying to raise bridge rounds with existing investors rather than going to new investors to try to raise big rounds. Okay, because they're not getting the valuations they're looking for, or they're directly getting no's. So the mindset in 2023 is to be able to survive or to extend runway until 2024, and let's see if in 2024 we can get this new dynamic where we start to raise funds at higher valuations. Okay, so what is the mindset that we advise our startups having? It's to plan, and this is not just now, we always advise this, aim for the optimistic case. Okay, so there has to be the ambition that startups have. When you make decisions, you have to base on the base case, okay, but you have to fund the company for the worst case. So when you are looking into runway, you better be sure that you're considering the worst case, for example, in terms of collections. So be aware that if in your business plan you have a revenue that is booming, be careful when you look at your cash, because that means that you're going to collect a lot of money. So maybe you're not being so cautious on the cash position that you're going to have at each moment of the following months. Okay. So let's cover the different financing alternatives that we can find. Okay. So first of all, there is the public funding. In public funding, we see that it's very different from one country to another, of course, because it depends on the government mainly. It can have different middle companies that do the allocation of the capital allocation, but there's a lot of regulation that affects public funding. Okay, there is also European, okay, and we can cover a bit of both, but there is a huge impact of the law that applies in each country. Okay. What can we say about public funding? You can have two kinds of funding. There is the grant that you don't have to give back, and this is the best way of funding you can get for your company, of course, because it is free money. The thing is that it is really hard to get. Okay. And in almost every grant, there are requirements for bank guarantees. Okay, whenever you apply for a grant or a public loan, even there is a huge workload in terms of preparation of a justification on how are you gonna invest the money, what is it that you want to achieve, what is the process that your company is gonna follow, and in what timeline in order to get it. Okay, so usually companies hire external consultants. In this case, we also offer this service at the Startup CFO, because there is as I said, a ton of work to do here. So it's better to be accompanied by someone that knows how to elaborate this kind of justifications. Okay. Whenever you apply and you get the concession, how it usually works in terms of deployments or disbursements is you have to achieve several milestones in the timeline that you have provided. For example, imagine 2 years. You can get 1/3, imagine, at the beginning. Then in 1 year time, you have to justify what you have done in that year. And there is a huge work here, because you have to be very careful on how you assign each cost that you had in the company and how it contributed to the final goal that you presented to in the application. Okay. And then if justification goes correctly and you are on time, you get the second disbursement. Maybe it can be the second 1/3. And at the end of the project, when the 2 years are ended and the project is fulfilled, you again have to make the justification for the second part of the project. And if it has been successfully carried out, it's when you get the rest of the money. Okay, so it's not like a bank loan that works very easily, where you just like really fast application period and you get the money and that's it. Here you need to be aware that it's a constant effort during the duration of the project. Okay, of course, what you get back is very good conditions. Okay, both in terms of, well, of course, grants, because you don't have to give it back, but also in terms of loans. There is usually a lower cost than you can see in bank loans, or you can see a very long period where you have to pay nothing. Okay, so your grace period can be from 1 to even 3 years, and after 3 years you start to pay back the loan. Okay, so if you calculate the IRR, even if the cost is higher than a bank loan, the IRR is lower, because you have had imagine 3 years of grace period. Okay, and another important topic here is how you account this public funding. Okay, especially when it's a hybrid model between grant and loan, it is tricky how you account it, because it has to be correlated with the costs that the grant is funding. Okay, So it's we see in almost every company where we start working that if they have previous grants, they are not accounted correctly. Okay, so this is very, very typical. So what is our advice in terms of public funding? Okay, try always to maximize it because of the conditions, because it doesn't consume debtness when you look from a banking side. Okay, so if you have a bank loan, they can have access to your historic and see how many debt you have in your balance. It doesn't happen with this. Okay, so this is another kind of funding that is always, it always has to be maximized. But assume the time frame that goes from whenever you apply to whenever the concession is done and when you receive the disbursement. So don't count on it when you're looking into your runway or into your cash forecast, unless you have the signed confirmation and you know that it's going to be wired to your bank account next month. Okay. But if it's an application that is still pending to be done, don't count on it, because it can happen that they give it to you, but the disbursement is not done until 6 months later than you expected. And in a startup, in terms of cash, those six months are really, really difficult to survive. So don't count on it. Just celebrate if it comes, and that's it. Okay, especially because of the timings. Just a quick note on public funding. I don't want to go into specific ones because, as I said, it depends on the country. But in terms of Europe, there are lots of like tons of funding available for startups, and each year you can see that Europe is giving out more money to try to invest in companies that can make an impact, that try to digitalize the economy, try to, well, in fact, they are really focused on startups or companies in general that are involved in terms of caring about the ecosystem. For example, electric vehicles is really looked carefully by Europe because they want to invest in it. Okay, or female entrepreneurs have some special programs because they want to incentivize this kind of entrepreneurship. Okay, so just for you to know, there is a lot of options in Europe. The biggest program is Horizon, okay, where the main product that we have worked is EIC. Okay, we have some clients that have got it, but just for you to imagine how hard it is to get it, the success rate is at 2%. Okay, so it takes time to prepare the application. If you want to go for it, you have to assume that you're going to have to spend time on the application, and later on, if you get it, on the justification. Okay. Next point, bank financing. So regarding banks, this is a bit curious because they give you money when you don't need the money. And I know it sounds contradictory, but it's reality. Okay, so if you go to a bank asking for money when you have 3 months runway, that is mainly when you need the money, you're not going to get it because it's a huge risk for them. Okay, instead, what we always do with our clients is whenever we raise a financing round, 2 million, 3 million, or the amount that we raise, it doesn't really matter. It's going to affect how much money you can get from the bank. And that is the moment to apply for bank loans. Why? Because the idea is to extend your runway a bit more and to have more money available to invest in your company. Okay, and for the bank, it is better to invest in a company with a low risk of repayment, okay, So they're looking for startups that have runways longer than 12 months, I would say. Okay, 10, 12 months is their trigger in order to analyze it from the risks department. Okay. What I was saying before, that timelines regarding bank loans is much shorter than with public financing. Okay. So here, if you apply, if you go to speak with a bank, you prepare all the information they need from you. It can take 1-2 weeks. You may have another 1-2 weeks conversation with a person in the bank. And after 1 month, more or less, or even, I mean, if you're fast, you can do it even faster. It is sent to the risks department, and you can expect an answer from them in a time frame of 1 week to 1 month. Okay, so it's much faster than public financing. Okay, conditions, interest rates are okay-ish, I would say. Some, like, until last year, conditions were great because interest rates were really low in Europe mainly. Now we're seeing that interest rates are growing, so this kind of loans are a bit more expensive, but still it's in good conditions. Okay, you can also get 6 months to 1 year grace period. You have to pay back the loan, imagine, in 4 to 5 years, sorry, and with interest rates that can go from 3 to 5-6%, maybe, more or less. Depends on, of course, the company, the risk that the bank is assuming, if you're giving guarantees or not, if there is a collateral or not. Okay. Compared to public financing, the way it goes into accounting is quite easy. I mean, it's just a liability in your balance sheet, and that's it. It has to be divided between long-term and short-term depending on the repayments you have, principal repayments you have to do in a period of time lower than 1 year. Okay, whatever you have to pay before it goes according to the fiscal year. In the next fiscal year, whatever you have to pay goes to short term, the rest of it goes to long term. Okay, and that's it. And final point here, it's how do banks analyze this kind of operations? Okay, we have seen that banks have improved a lot on this. I mean, if you went to a bank to ask for financing for startups 7-8 years ago, there was no way you could get money. Okay, nowadays banks have invested a lot of money and effort in trying to create internal departments so that they can analyze the startups in a different way. Okay, and they have the way of measuring risk with this kind of companies, but still the way they analyze it is very old-fashioned. Okay, they're really looking, I mean, if you go to a bank and they see your profit and loss and they see you have a negative net income, they're gonna be crazy. And that is reality for every single startup. Okay, or they're looking a lot into your balance sheet to see how your equity compares to your debt. Okay, so that applies to big companies where there are big levels of debt, but in startups you are not gonna find that because they're mainly financed with equity. Okay, so this kind of ratios, for example, debt to EBITDA, they don't want it to be more than 4. Well, if I have a negative EBITDA, that's it, end of story. So you have to look more into qualitative things than focusing on quantitative and ratios that you can calculate with your profit and loss or your balance sheet, right? So what is our advice here? As with public financing, try to maximize it. Okay, it is hard to get financing from banks for startups because if you think about it, a VC can assume a default rate in, what can you say, half of their companies or even more, because they are gonna get huge returns in a few startups that they have in their portfolio. Okay, if they can give back the whole fund with one startup, then that's it. Everything that comes later is upside. Okay, but for banks, it doesn't work that way because they are really limited on their upside. Because if they're giving you a loan at a 3% interest rate in 5 years, the downside is they lose the money they lend you, and the upside is really limited to that 3%. Okay, so they can't assume a default rate higher than, what can I say, 5% maybe. That can be their threshold. Okay, so they're not gonna give big amounts of money to startups. Okay, they're really careful on how they allocate their capital. Never endorse this kind of loans with banks with personal guarantees. So there is a huge risk in a startup. The C-level or the founders are already compromising a lot with the company itself, and we never recommend to give personal guarantees because who knows what can happen. Okay. Of course, I speak to more than one bank at the same time, okay, because you can get no's from most of them. So try to reach out as many as you can, okay. There is an important topic here is try to negotiate with all of them at the same time, okay, because it's the moment where you want to maximize funds in order to extend your runway. So it's better if you get all the money at once, because if you first speak with one bank, then you go to the next one, in 3 months to the next one, they're gonna see that you have debt with other banks, and they're not gonna be so interested because they see a higher risk. Okay. In terms of timings, what I said right after a round, and this is really important because when I speak with entrepreneurs, I see that when we close a round and I tell them, okay, let's go for bank loans, they say, no, now that I have money, I don't need it. And my message is always, now that you have money, you don't need it, but it is the only moment where you're gonna get it, and you're gonna be grateful that we did it in 10 months. Okay, so the moment to go for it is just after you close a round. Always try to negotiate long terms. Okay, they're not going to give you a loan for 15 years, of course, but try to aim to 5 years periods. Okay, and that's it. In bank loans, you have different products: loans, credit lines, confirm, like factoring, reverse factoring. There are many of them. We always try to aim to long-term loans, and depending on the business model, you can also apply to credit lines or factorings in order to improve your working capital. Okay, so if you have really long collection periods from clients and you pay to your providers on the spot, that could be an interesting instrument for the startup too. Okay, and the last one in traditional funding is venture debt. Okay, venture debt is a hybrid between a loan and equity. Okay, so not only in the way the product works itself and what they get back for the money they give you, but also on the way the dynamics work. Okay, so usually if you ask for a loan, imagine of 2 million, what you're getting is a schedule of repayment as it was a normal loan that you get from a bank with a higher interest rate. It is true that they give big amounts of money. So where a bank can give 200K, maybe a venture debt gives 2 million. Okay. So the thing is, they don't only get a repayment with an interest rate, they also get a small part of equity of the company. Okay, it's called equity kicker, and they convert not for the 2 million, just for a percentage of the 2 million. I mean, it depends on the venture debt, but it can go from a 10% to a 30%, more or less. Disclaimer here: every venture debt works on a specific way. This is not standardized, okay? So you can find really different conditions from one to another. Okay, so regarding dynamics, that is what I was mentioning previously. It is quite similar to how a financing round works with venture capital. So you're gonna have to prepare for a tough due diligence where you're gonna have to provide lots of documents. You're gonna have to give answers to lots of questions, and it is not as fast as bank loans. Okay, so a fast round can be closed in 4 to 6 months. Okay, with venture capitals, with venture debt, it can be a bit faster, but the dynamics are quite similar. Okay, and lastly, with venture debts, contracts are really, really complex. Okay, so you can have lots of clauses that affect what I was saying. How much equity do they get? At what valuation? What is the way of repayment of the loan? So as it has the two components, loan and equity, the clauses can have so many combinations between them that it makes contracts really, really complex. So our advice regarding venture debt, it's complex to get. We have tried to get it several times and almost never successfully. Prepare yourself as it was for a funding round. Okay, don't look for it when you have 2 months runway. It takes time to close venture debt. Okay, try to talk to other CFOs or to other CEOs that have gone through this kind of processes, because if you know that someone has raised venture debt from a specific company and you're looking forward to that company, try to understand how they work and what conditions they are going to offer, and how it's going to impact your company. Okay, but it is true that it can be the only alternative to a funding round. So what I said, they are willing to give huge amounts of money, not like you can find in traditional banks. Okay, so of course they're asking for higher interest rates and for a small percentage of the equity, but they're willing to give big amounts of money. Okay, so far we have covered the traditional ones. Any questions here? Well, any questions you can have during the webinar, feel free to ask. Okay, I prefer if you ask directly, because I'm not always looking at the chat, so it's better to raise your voice. Okay, so let's go with revenue-based funding. Okay, so this is something, as I was saying at the beginning, quite recent if you compare it with bank loans, for example, and it has found its place somewhere in between bank loans and venture capital. Okay, they work on a slightly different way, mainly on how they evaluate the amount of money they are willing to give you and on how you have to repay it. Okay, so let's go into it. So basically, how it works is, I'm gonna give you an amount of money and you're gonna pay me not with fixed installments, but you're gonna pay me with a percentage of your revenue. Okay, so imagine you pay me 5% of your monthly revenue. Okay, and what you have to give back to me is not the 500K plus an interest rate. It's more like a multiplier. So you're gonna have to give me back 1.5x what I gave you. If you look at it, it's a 50% more, but it's usually doing on a multiplier. The interest cost is not fixed as a percentage because it's gonna depend. Okay, one thing is that you pay an X% of your revenues, and another is that the cost of that loan is that X%. We're gonna see this later on with a quick example in Excel, okay? But for you to have it in mind. So with this kind of repayment, of course, the period is not fixed because you don't know how the revenue is gonna grow. Okay, this has an important advantage, that is that the debt is not risky because you're not obliged to repay in fixed months or quarters. You're gonna repay based on how the company is doing. Okay, so you assume much less risk than you can do with a fixed loan. Okay, to the question if it is expensive or cheap, it depends, and it depends on a good way. Why do I say that? Because if your revenue doesn't grow, then you're gonna repay a small amount. So you're not, what I was saying before, you're not compromised to pay in the next year. If the company doesn't grow as expected, you can then pay in 3 years, and that's okay. If the company starts to grow a lot and your revenue skyrockets, you're gonna pay the loan really fast. But that is a bad news that you want to have. It means that your company is growing so fast that the only bad consequence is that you're repaying too early your loan, hence having a higher cost of capital. But I mean, if it's in exchange of seeing how your company grow, believe me that it is absolutely worth it. We can play with the numbers later on in the Excel so that you can see the different impacts. The amount you're willing to give you can be high. Okay, so we're speaking here about 2x, 3x, maybe what a bank can give you when in the same conditions. There is an important part here. It depends on the company that is financing you, but you can have some restrictions on the usage of the funds. Okay, so there are some of them that, for example, say you can only spend this money in marketing campaigns, and you have to get their approval in every single invoice that you want to pay with the money they're giving you. And of course, this complexity in the product means complexity on the way it goes into accounting. Okay, same as with public funding, as you don't have a specific repayment calendar, the way it goes into accounting is not that easy. So let's go to the Excel file. I have it here. It's really simple, okay, but just for you to understand how this works. So this is a use case. Here, what you get is a loan of 500K. This amount is determined on a multiple over your MRR. So imagine this is your monthly revenue. You're getting 5 times what you have as of the month when you are requesting the financing. Okay. How much do I have to give back to the company? Well, it is a multiple over what they give you. Okay. So in this case, it's 1.3, the $500,000. How I'm going to repay the loan is a 5% of my revenue. Okay. So this is going to be fixed percentage over a variable that is my revenue. We're assuming here a revenue growth of 6% on a monthly basis. Okay, so you can see how my repayment increases. Okay. What is interesting here to see how the IRR for the company that lends the money change depending on if the company does good or not. So if the growth comes down to a 2%, you see that their IRR is lower. Why? Because you take more time to repay the loan. Okay, so with a 2% growth, we have an IRR of 8.6. With the 6%, we have a 13.9 IRR. Okay, but if we increase the growth like crazy to 15% on a monthly basis, the IRR goes up to 23%. So they're conditioning the repayment, so that their internal rate to how the company performs in terms of revenue. Okay, so they are assuming a huge risk on believing what the company is doing on how they are gonna. That is more or less the same analysis that VCs or investors are looking into a company. You're looking for different parameters than traditional banks can look for. Okay. That was just a quick analysis through numbers so that you can see how revenue growth can impact the repayment of this kind of loans. Okay. Here you can find just a list of companies that give this kind of financing. For example, we have Ritmo that is more focused on e-commerce. Okay, so what they do is they give you an amount of money based on your revenue. Okay, and for example, Ritmo works on a weekly basis. They connect to your platforms so they can have certainty over your revenue, of course, and they get the repayments on a weekly basis according to how your revenue performs. Okay. Wayflyer, it works quite similar. Okay, to Ritmo is basically the same, just another actor. Okay, Lighter Capital is another one. This is a bit different. You also have Outfund, for example. In Outfund is the case that I was mentioning previously, where you have to provide the invoice because they are willing just finance marketing. Okay, so if you want to pay a supplier with Outfund, you have to provide the invoice and you have to get their approval, and it's then when you can do the payment to the supplier. Okay. Bubos, this is a really interesting one because what they finance is a bit different. Okay, what they're financing is the purchase of assets. Imagine there is a startup that is willing to buy another startup. So what they're gonna give you the money for is to do that acquisition. They are just gonna finance, of course, a percentage of the purchase price, okay? And you're gonna repay the loan they are giving you in 5 years' time. Okay, so it's very focused on a specific activity that is assets acquisition. But the truth is they're growing really fast and their conditions are okay, assuming the risk in the activity they are financing. Okay, this is just an example on how it works, where you pay like the same amount on a yearly basis. Okay, until you give back the whole loan that you used to carry out the acquisition. Our advice with revenue-based financing, it doesn't take, I mean, it's not good for the company in terms of if you look at it from a finance point of view, until you don't have 4-6 months of runway or 6-8, because the cost is high. Okay, so you can guess, as we saw in the Excel file, if you get 10-15% cost on capital, that is expensive money. Okay, of course, it depends on the interest rates, but just get this kind of financing when you start to feel that you need it. If you have runway for 18 months, then it's not yet the moment to look for this kind of funding because you're not using well the funds that you already have. Okay, and these kind of companies are not gonna expect from you to have 18 months runway so that they can finance you. They assume at which point of the startup life they they're getting in and what is it that they are financing and what the funds are used for. Okay. What is this good for is if you see that your business is doing well, okay, and you're starting to run out of money, it is a very good way of extending your runway, maybe 3, 4, 5 more months, so that you delay the next funding round that you need. That means a higher valuation. Okay, so imagine that you are growing at a 10% monthly rate. If you get to delay your round 5 months, your valuation will be much higher, both because the variable where you get the multiple for the valuation, imagine your ARR, if it's 10 times ARR, if you get 2.5 million ARR instead of 2 million in those 5 months, your valuation is going up from 20 to 25 million. And it's also going to affect positively, maybe in the multiple. Okay, if you're having a good growth in the last months, there is a justification to say that the multiple shouldn't be 10, but it would rather be 12. Okay, because you're growing really fast. So trying to extend runway based on this can be a great decision, and we always recommend to our clients to go for it whenever the right moment comes. Okay, they're gonna look at different metrics than traditional banks, for example. They want to see good unit economics. That's it. They want to see that the company is able to perform well and that they have the instruments to make the revenue grow. And last of all, Capchase. It is different from revenue-based because the repayment is not based on how your revenue grows, but it's similar. Okay. So how does Capchase work? You ask for it's like a credit line. Okay. So imagine they give you 100K. What they're gonna give you in that moment is that 100K less their commission. Okay. So with a commission of 8%, for example, they're gonna give you in that moment 92. Okay. But the amount that you have to give back to them is gonna be the original 100K. Okay. So then you're gonna have the 100K divided into 12 installments. They're fixed. Okay. So it doesn't vary regarding the revenue as we saw, for example, with Ritmo, Whiteflyer, or many of this. So you're gonna pay a fixed amount of money in a specific period. But why is it interesting? Because of the way they calculate how much money you have available, okay, and the way you can get that money from Capchase. So you're gonna calculate the amount of money you have available based on a percentage over your ARR. Okay, they usually start with a 30-35%, but this can improve with time. If you are using Capchase, you're paying the money back correctly, and they see that your ARR is growing, the amount of money you have available can grow a lot, both because your ARR is growing. So 30% of 1 million gives you 300K available, but the same 30% of 2 million ARR gives you 600K available. And what usually happens is that they increase the percentage that you have available. Okay, so this would mean that you start with Capchase with a 30% of 1 million, and in imagine that in 1 year I double my ARR. Okay, I'm gonna have a 60% available of my ARR. So now I have 1.2 million. So I have come from 300K to 1.2 million in 1 year. This is what I have available. Okay. Another important thing here with Capchase is that whenever you give back an installment, that is money that you automatically have available again. So imagine I have 120K from Capchase, and I have to give back 10K each month. Whenever I pay back those 10K next month, the next day I can take those 10K in financing again. Okay, so you can repay and retake the money so that you can leverage on Capchase. Okay. It is not really a loan because it's more like a commission, because what they are doing is they're buying your future cash flows. Okay, so it's similar in dynamics with a bank loan, but there is a essential difference. And an important way to take a look into Capchase is be careful, because the fee they're getting from you is not the real IRR. And why? Because that 8% is calculated over a basis of 100. Okay. If you repay those 92 at the end of the 12 months, then that's the IRR. But the thing is that you are going to repay on a monthly basis. So as you're giving back a small amount of money every month, the IRR is higher because the money you have available is lower. If I had those 100K for the 12 months, then it's okay. But by the end of the 6th month, I'm only gonna have available 50K. So be careful with the difference here between IRR and the fee. The IRR is always gonna be higher. And of course, they're gonna ask you to have some runway. If you go to Capchase with 1 month, they're gonna say, I'm not gonna assume this risk. Revenue-based and Capchase, they're willing to assume a higher risk than banks, of course, but they're not stupid. So they're gonna ask you to have at least 6 months of runway so that they're not risking too much their position. Okay. What is our advice regarding Capchase? I've seen in lots of CEOs that they look at it as a very expensive way of financing. But what I always say is giving equity is much more expensive. Like raising a round is the most expensive way of funding that you can find out there if you believe in your company, because this is meaning that you're giving a small amount of what the company will achieve someday. And if you believe in your project, this is going to be a lot of money. So even if the cost of this non-dilutive financing goes from 10 to 15%, it is expensive if you compare it with traditional funding or financing, but it is cheaper than giving out equity. Okay. And the amounts of money you're getting from this kind of sources is much bigger than what you get from banks. So it is worth the cost. Okay, be careful here on when to apply, because as I said, don't apply to Capchase. Don't think about getting Capchase immediately after the round is closed, because you still have enough runway. But think about it when you are between 10 to 7 months of runway, and it's a moment where you start to get some traction so that you can leverage on Capchase to grow. Okay. As I said, the repayment you do is money that you again have available, so you can use Capchase to repay Capchase. It's a bit weird in concept, but it works like that. And if you really grow as the percentage increases and the ARR increases, there can be a way to skip a funding round, or as I said before, to delay it even like 1 year. Okay, if you perform really good. It's expensive, as I said, compared to traditional financing. Okay, so be careful on when you apply to it, but again, much cheaper than giving out the equity of your company. Okay, so what's the summary in all of this? Always try to maximize public funding. Okay, it's the best conditions you can ever get, but be careful with the timings here and assuming that you're gonna get it. Then try to raise also as much long-term back as you can, because cost is low, although you're not gonna get huge amounts of money, but it's good and cheap money. Be careful with venture debt because it's complicated, it's complex, the process is hard in terms of due diligence, but it's a good way to get big amounts of money, giving out less equity. Revenue-based funding. Look into it if you consider it matches your needs. Okay, so if you're an e-commerce, for example, and you have to invest money in marketing campaigns so that your revenue can grow, this is a good target for revenue-based funding. And last of all, Capchase is great. It's focused on SaaS companies, okay, because as I said, they are looking into your ARR to buy your future cash flows from your clients. Okay, so if you're an e-commerce, you cannot apply to Capchase. But for SaaS companies, it is really interesting as a way of financing your growth, okay, and delaying the funding rounds for getting bigger valuations. Okay. So until here, the theory. Any questions you may have, any stories you want to share, real examples? In terms of examples, I've seen several startups that have been able to grow a lot with Capchase. Okay, so it's a really useful source of financing that really provide help to startups when it is the right moment to go for it. No questions, suggestions? Okay, so thank you very much. This was the last webinar, as I said, of our webinar series. As we got to summer, so please feel free to contact us or me personally. You can find me on LinkedIn, or you can contact us on sales@tscfo.com. There might be a way we can help you for sure. So thank you very much for your time and enjoy summer.
Great, thank you.
Thank you.